Hey guys, this is Balto, and I'm going to go over how I do my technical analysis, or TA. This is going to be a little bit boring, but I do think that if you want to know how to do something correctly, you should know the history of it. So, first off, the history of TA. Technical analysis of stocks and trends has been used for hundreds of years. All right, in Europe, Joseph de la Vaga adopted early TA techniques to predict Dutch markets in the 17th century. But people like Charles Dow, who co-founded Dow Jones and Company, William Hamilton, who was the fourth editor of the Wall Street Journal, Robert Ray, who was the founder of the Dow Jones theory, which states that stock movement is a form of TA that includes aspects of sector rotation, and all of their friends, they were the creators and the founders of today's technical analysis. We look up to them, and they're the ones that pretty much taught us how to do technical analysis for stocks that trade today. Candlestick patterns date back to Japanese merchants that were eager to detect trading patterns for their rice harvests. Right, so studying these ancient patterns became popular in the 1990s in the U.S. with intent to day trade. Alrighty, so now we know the history of technical analysis, how it started. So if you guys have any more questions about how it started, feel free to do your own research or ask me. I am a history buff on that. Now we're going to move on to what technical analysis does for you. All right, so technical analysis is a blanket term, right? It's used for a variety of strategies that interpret the market or specific stocks. Some technical analysts use trend lines, some use candlesticks, and some use boxes and bands. Some, like me, use a mix of everything. I tend to try to keep it simple because I know we have a lot of new traders that always shuffle in and out. And I always think that simple is better. But um, technical analysis gives you an idea of where to buy and sell a stock, an idea of who's going to be buying and selling a stock as well. So good examples are short sellers and FOMOs. If you don't know what a FOMO is, it's someone that has the fear of missing out. So when you see that stock um, at market open, you see it just skyrocketing and it halts, and then after 5 minutes when it unhalts, it just rockets again and halts again. Those are FOMOs. They're scared of missing out. They see the stock jumping up $2, $3 every time it unhalts, and they just don't want to miss out on making all this money. So that's when they're buying. As soon as that stock stops halting, that's when the short sellers are going to get in and they're going to make their money as the stock dives right back down. Alrighty, so now you know what technical analysis does for you. Now we're gonna go into how to use it. So, how to use TA. Chart patterns are a subjective form of technical analysis. So, what you guys need to know, and I'm going to reiterate this point, I believe 2 or 3 more times during this video, is that chart patterns are different, right? How I do my charts are going to be different from how another pro trader will do their charts. So you got to know that they're subjective, and this is where analysts try to identify areas of support and resistance on a chart by looking at specific patterns. These patterns are usually psychological and are good predictions of where prices are headed. Right? The best analogy I can use is poker, where you can read the facial expression of your opponent, and let's say he has a major tell, right? So whenever he gets a good hand, he smirks. Right? So when I see that pattern in a stock, that's the tell sign for me, right? That's the smirk. And that's when I'm going to know that I need to enter or exit a stock. All right? So before we go over patterns, I'd like to remind you guys that patterns are just educated guesses. Just because a stock looks like it's following a pattern doesn't mean that it will. There are um, they're called patterns because they tend to do the same thing, but if patterns worked 100% of the time, then we would all be rich. All right, so that's something to take into consideration. Something else is that when I find a pattern, I look for where my stop loss is going to be and I assess the risk. Right, I want to make sure that the trend is confirmed before I buy. You'll notice the entries and exits in the photos below, but you want to ask yourself, is the risk worth the reward? Right, so if I'm entering a stock and there's potential to make 50 cents per share, but I have to put my stop loss $1 below, that's not really a smart trade because that risk is double the reward. So it's not worth it. You have to make sure that the trade is worth it before you enter. All right, so let's start getting into patterns. Bilateral patterns are my personal favorites. Right, there are 3 major bilateral patterns. That's the ascending triangle, descending triangle, and symmetrical triangle. I love these because they're so easy to spot, and most of the time they break out instead of consolidate. Um, I use these a lot as a day trader, so I always looked at the most volatile stocks. Whenever you see that wedge setting up, it's a perfect time to enter. The reason I like them so much is because it's kind of like flipping a coin, right? Your odds are always going to be 50-50 that it's going to land on your side. And if it doesn't, you can stop it using your stop loss. If you're consistent with how much money you put in to each trade, it's almost impossible for you guys to go red. But you have to set some rules for yourself. The reason why I say it's almost impossible for you to go red is because if you're flipping a coin, let's say, and you use a 2% stop loss, which most day traders do. So if I have a 2% stop loss and I'm looking for 10% gains, every time I flip a coin and I lose, that's only 2%. I have to lose 5 times in a row in order for my 2% stop loss to hit 10% losses total on the day, let's say. But as long as one of those trades actually ends up with a 10%, you break even, right? So 10 losses plus 1 win is you're still breaking even. That's 6 times that you've played and you're still even. That's why I think like if you flip a coin 50-50 and you lose 5 times in a row, that's going to be kind of hard, almost impossible. So some of the rules that I set for myself, I listed below. Rule number 1, never spend money that you're not willing to lose, right? That should be every trader's rule number 1. There has been so many times that I buy a stock and accidentally forget to set a stop loss, or I don't set my stop loss to be good until cancel. So at the end of the day, the stop loss is canceled, and in the morning I wake up with double the amount of money lost than I was willing to lose. So you want to be careful, and you want to make sure that whatever you invest, you have to be willing to lose. Never trade the first 3 minutes of market open. That's my second rule. I believe that the stock market is too volatile in the first 3 minutes, 3 to 5 minutes. Looking at my past trades, I can see that most of my trades that I do within the first 3 minutes end up going red. So I have decided to make that one of my rules to not trade in the first 3 minutes of market open. Next rule is price targets are not suggestions. If you set a price target for yourself, make sure you follow it. You either have to scale some of your position, you have to sell your whole position, or you have to move up your stop loss. You have to secure profit no matter what at a price target. Rule number 4 is I must always use a stop loss, right? Lottos are excluded. If you guys don't know what a lotto is, that's just a trade that I think will possibly go up, could possibly go down. I really don't care if it hits $0. I am just in it to hopefully make 100% trade, pretty much. So you must always use a stop loss on every trade. I do exclude myself from lottos because I don't really care what happens to those. Next rule is that you cannot get emotional, right? This goes for whether you're losing money or you're being greedy. If you're losing money and let's say you put in $100, right? You put in a big portion of your account. Let's say you have $1,000 in your account and you put 10%, $100 into a trade, and you go down $10 in the first 2 minutes, you can't get upset and sell your stock and get all emotional and start messaging people saying, hey, why is the stock going down? Why is it going down? You should do your due diligence and find out why it's going down, and you should not make that mistake again. All right, but don't get emotional and start selling to make sure you don't lose more. Same thing goes for being greedy. If you hit your price targets, do not continue holding just because you think you might sell at the top. Nobody ever sells at the top. You have to be extremely lucky. Out of my 3 years of trading, I think I've sold at the top maybe twice, and that was just because I had a price target. It was my third price target where I sell my whole position, and I sold my whole position, and then it dropped instantly. And that was just pure luck, nothing to do with skill. So don't get emotional when you trade. And the last rule is 5 bad trades in a row, no new trades for 1 week. So similar to that, the bilateral patterns rule that I was saying about how if you have 5 bad trades in a row, then you break even. If you have 5 bad trades in a row, then you're doing something wrong. It's either or actually, that's not true. It's either you're doing something wrong or the market is just having a really bad day. So you have to make sure that you stop trading, you assess the situation, you have to see, okay, is the market bad or am I doing something wrong? If the market's doing great or at least decent and you're the only one that's messing up, that means you're doing your charting wrong, that means you're choosing the wrong stocks, maybe you're trading on the wrong industry, maybe you're trading in oil and you should be trading in electric, you know, anything. Reassess your whole strategy. Make sure that it's not you're looking at the patterns correctly, there's nothing wrong going on, and 1 week later come back to trading. Don't continue taking red trades because something might be wrong. um, yeah, so let's move on to reversal patterns. I use these less. um, we will go over one that I use a lot, but yes, reversal patterns, they're a little bit harder to spot, right? But they are my second favorite pattern type. You will see a lot of traders use the double top and the double bottom as well as the head and shoulders patterns in their technical analysis. I tend to use these patterns when I day trade, as stocks are more volatile and I'm constantly watching those candlestick patterns, right? I can see, since I'm watching the patterns so vividly, I can see the head and shoulders formings or the double tops and bottoms. So that's when I'll use these reversal patterns more. Otherwise, I'm usually sticking with the wedges or the triangles, however you want to call them. A bullish reversal pattern is usually formed on a downtrend. So make sure the trend is confirmed before you enter. If you guys look at the pictures, you can see that there's the entry above the neckline or below the neckline, whatever you're doing. If you're looking at, let's look at the double bottom, right? Bottom left photo on the reversal patterns. You can see as soon as it hits that neckline, you have to wait for it to go a little bit above, and that's where you're going to enter. You want to make sure that trend is confirmed before you enter. Let's go over my favorite type of reversal. It's not in the photo above. You will see a photo below. But it's another reversal pattern off of a support bounce. Lone Star, who is the owner of Longhorn Investing, LLC, he found a great one that a lot of us banked on, right? I think we all made like 60% within a day, less than 24 hours. The ticker was LEJU. The photo is below. It has a bounce off of the same support area since April of 2018. Alrighty, so since it bounced off of that $1 line 4 times, I'm going to assume that it will do the same thing this time, but I have to take into consideration that the stock has dipped 67% since February, and I'm hoping that the support will catch and it will bounce the stock way back up, right? So that's something that you have to take into consideration. So I drew out a new potential swing on LEJU. I want you guys to practice finding similar patterns and throwing them in the chat for all of us to discuss. I will have the link to our Discord below if you guys ever want to join. But here is LEJU. This is the pattern that I was discussing. You can see this is the reversal. As soon as it hits that $1 bottom line in April of 2018, I circled it. It bounces right back up. Again, at the end of 2019, it hits, bounces right back up. Again, in September of 2019, end of the year, bounces right back up. March of 2020, it bounces right back up. Here is where you want to hope for a bounce. And right when it hit $1, all of us entered, and we did hit our second price target. It did not go up to our third price target, but we did bank very nicely off of this play. Right, so this is the second play that I found. It's on the 5-day chart. You can see that it's setting up just a symmetrical wedge. It just keeps on bouncing. You can see it starts at the top there, hits the bottom of the trend, then back up top, down to the bottom, and continues. Now we're at the end of the wedge. We're sitting at $1.33, and it can go either way. So this is the 50-50 coin toss that I was talking about. These are the plays that I love because I can always stop the stop loss. Now I want to go over price targets. I know that a couple of people have direct messaged me with questions about how to set price targets, when to scale. So you have to understand that price targets are also subjective. So every trader is going to have different targets for every trade. It depends on the stock. It depends on how many shares it has, what the float is, and just like LEJU, you have to look for where the stock consolidates. So you have to look for where it consolidates above your entry point and put a price target in that area. So right where it's consolidating, a lot of people want it for that price. They don't want to sell, but a lot of people don't want to buy. That's where you're going to set your price target. Um, and then take into consideration where your stop loss is and make sure that you don't have a 10% stop loss with only a 5% price target. Make sure that the trade is worth it. Assess it. Let's talk about when to scale out. All right, there's not much I can say when it comes to scaling out since it's your money and your trade all the time. Whether you play safe or risky is on you and your rules. I change my strategies according to the season. So if you guys want to trade similar to me, I know that January to April, it's usually pretty normal trading. Then we get into the months of May through July and it starts slowing down. I'm really not sure why. Personally, my thought is that it's springtime. A lot of couples got married in this time. So men are pulling out their earnings to buy jewelry, but that's all hypothetical because who even buys jewelry anymore? Then we get to August and November, and that's my best trading season. Past 3 years, that's where I tend to make the most money. But again, seasons can change. Then late November to December, it slows down again. People pull out money and they start buying presents for their kids, for their spouses and loved ones. So that's just how I see it. It really depends on the trade, and make sure you pull your money out when it's at the top. Don't always hit those price targets, and scale, don't hold, and see a negative 60% in your account. All right, the best advice I can give is to not be greedy. The stock market will have winners and it will have losers every day. Don't go from being a winner to a loser because of greed. Once a trend is confirmed and your position is up 5 to 10%, I would bring the stop loss down to your entry because I would rather have I would rather come out of a stock with $0 made than negative dollars, right? I want to thank you guys for taking the time to read all of the work. I put a lot of work into this. I want to reiterate that this is my personal strategy, right? This is what works for me, and it might not work for you. I've changed strategies a handful of times until I found what works for me. It's a trial and error, guys. So even if you don't use my strategy, I hope I was able to teach you guys something new about technical analysis, and I hope that you guys continue your education in the stock market. Please feel free to subscribe, and I will drop a link to Longhorn Investing Discord below. Thanks, guys.